It is Monday, June 1st, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And it was yet another virtual jiu-jitsu, get your ass kicked at jiu-jitsu Monday. Hopefully that'll be changing soon. Been feeling kind of lackadaisical that I haven't been as on it. But I did do a really intense workout while I was allowing them to watch me. That's one thing. They've been doing these virtual classes in my jiu-jitsu school for a while now, and it's not mine per se. It's the one that I go to. I don't know how to explain that. Yes, it's mine in that these are the people that I typically train with and have been training with for almost 4 years now. So yes, in that sense, it's my gym. It's not my gym in that I'm not the one that owns it. I'm not the black belt that instructs at it, or a black belt that instructs at it. I just take classes there. But anyway, they haven't decided to challenge the Queen of Oregon, fucking hair Kate Brown. As far as I know, her authority, her executive authorities, her executive powers have lapsed. I guess it's like they have like a 14-day or a 30-day period that we can be in a state of emergency, and that the police have to enforce the thing and whatever. But we're past that. We've been past that for about 60 days now, and as a matter of fact, it's been her constitutional authority or whatever to do what she's doing has been challenged in court, and the court found that the case was sound and that she in fact is in violation of Oregon law right now, and she has been for at least a week. But nobody's saying anything about it. And this is the thing that pisses me off even more than all the fighting and all that shit, is that our authorities are not following the fucking law. If we are going to go by rule of law, then they need to go by the fucking law. And when the law says your fucking executive powers have lapsed and sunsetted, then that means they fucking sunsetted and you stop enforcing them. That's it. Period. I'm so sick of this shit. This is not a country where the fucking governor gets to just point down at you and say, no, you can't train jiu-jitsu anymore. They don't have that kind of authority. It's not theirs. It's nothing illegal or untoward about jiu-jitsu or training it. And I'll tell you what, if they ever did make it illegal, they would probably have like fight clubs everywhere and shit, because it's grown into like the American culture and shit. But yeah, I'm very disappointed with the way that people have deferred to these authorities, and especially when these authorities have stopped acting like the authorities and according to the description of what their job is. Governor is not Queen of Oregon. You don't get to fucking circumvent or jump over the Constitution whenever it doesn't suit you and it doesn't fit your goals or whatever. No, it's there for a fucking reason. I think that's that's one of those points that I like to bring up to those who talk about the social contract. What does it mean, or like what happens when not me but the other party changes the terms of the contract or violates the terms of the contract? My signage isn't implicit. It's not guaranteed. It's not just because I was born in one spot, you get to fucking rewrite all the conditions of our agreement in this social contract at your will. It's not how it works. And I'm sure that if somebody were to present the American people with terms like that, they would be told to fuck themselves, probably by the meekest among us. And I believe that that's probably the thing that we'll see the most in the next weeks and months ahead. Is that and I don't know to take solace in it or not. It seems to me like the people are generally peaceful, and that what we see of incitement and looting and torching and all that shit is basically people that were bad to begin with, tag-alongs, and people that are organized and trying to do so for government. And the reason they're doing it is because they're trying to disable otherwise functional businesses. You know, things like Starbucks and Target that are going to stay afloat because they properly spent. They've got decent books. Even though they have been closing some stores, but I don't know if that's in response to this or not. See, personally, I think that the economy has more or less completely stalled. There's some manufacturing going on out there and all that, but that for the most part, you know, things like consumer spending is completely in the toilet. And it's because it's been, you know, the incentive to create new businesses and the money that those businesses would have been making for people, it's not happening. The regulatory burden to start a new business is high enough that most people don't even bother. They're just like, I don't want to pay fucking excise tax. I don't want to report shit. I don't want to report all this. I don't want to deal with this bullshit. I don't have to, and so I won't. And the disincentive to go out and start a business has grown higher than the incentive. So even the businesses that are existing right now, because of this dearth of organic economic activity, because it's not happening, that transfer isn't happening for them. And so if they do have any liquid capital right now, what they're doing is they're buying two types of organizations. Number one, other successful organizations, and two, those that aren't so successful. And they do this so that they can hide all of their losses, and the one that's not doing so successful, carry it for a year, break apart all the little parts that work and are profitable, and all the parts that aren't profitable, they just shut them. It doesn't matter what it does to the rest of the economy, they just cut those out and just fire all those people. And it looks great on the books, you know, because you got those companies that were profitable over the quarter, and those make your successes look good. This other organization that didn't do so good over the year fired everybody. Not going to have to worry about that next year. You know, they've been doing this more and more for the last, I want to say, decade. It seemed to really accelerate over the last couple months here. And I attribute that to lack of actual organic activity. And that was before COVID. I think that was just a reciprocal response. You know, because it takes time for any kind of interruption in supply to reach out to the shelf. You know, it's like by the time it gets to the shelf, it's been in the supply chain for about 18 months. Depending on what it is. But I mean, if you think about that, so you got a year and a half to figure out what the fuck to do after it stops coming from its source. Well, I think we've already lapsed that year and a half. And that's just my perspective on it. That, you know, between that and between the state's reaction to COVID, which has been completely unscientific and irrational, uh, the current restrictions that are still being held over our heads, and now this fucking rioting bullshit. You know, I think it's just one big fucking psyop. You know, because if you thought everything was hunky dory and you went back to resuming your normal life, but you noticed that the streets weren't getting fixed and more businesses were closing and firing people, you know, just naturally, just firing people, and they weren't getting rehired, and there weren't more jobs coming back into the area. After a while, you'd probably notice. You can probably try and do something about it, you know, like move to an area that's not as struck like that. But I don't know. I think it's going to be really, really interesting over the next month or so. And eventually I expect that we are going to come out of it with a lot different expectations of government. I think we're going to be asking them to do a hell of a lot less. You know. Anyway, let's go ahead and throw down with some music. And you know we're going with Body Count, because that's what we do to begin with. But which song? Here we go. 99 Problems. First Dance. Here on Coin Metal. And that was Mastodon. That song's actually 13 minutes long, but I wasn't going to make you guys wait that long. Sorry. I didn't pick it. The computer did while I was still in the shower. Had to get that mat funk off. Did a little workout on the mat, but, you know, nothing big. Just enough to keep the body moving, you know? And, yeah. Gotta do it. Anyway, as far as what we're going to get into today, I got all kinds of good stuff. It's funny, I'm on Gab now, because Twitter still has me suspended for some fucking mysterious reason. I swear, man, I've seen so much vile shit being pitched from one person to another on Twitter, and, you know, I don't know if they ever get suspended or whatnot, but I know I got suspended for a hell of a lot less. So, I don't know. Very disappointing that I should still be suspended at this point, and I think it's been several months now. It's been since October, and yeah, it's fucking bullshit. Anyway, yeah, like I was saying before, as far as what we're going to get into today, got lots of goodness. I keep getting distracted by social media, man. There's so many people worried about with riots and shit. You know what? That shit can happen out there. It's not happening here, so I'm not going to worry about it here, you know? I had to get a little caffeinated, you know? Anyway, as far as where we're going, I got a couple tabs open here. Wanted to check and verify something on the Facebook, and we're not going to go there. Yeah, this is going to be something we cover. I came across a couple tabs, so it's like, I'm not sure where I wanted to start with this. Yeah, why not Yahoo Finance? It'll be short and sweet. Let me see if it actually refers back to another article, because they do that aggregation shit too. Let's see here. No, it was just some weird little thing I'm not going to read. Alright. Anyway, this is on Coindesk.com. Bug in time-locked Bitcoin contracts could spur miners to steal from each other. And this is authored on June 1st, 2020 at 8 UTC. And let's see, this is authored by Alyssa Hertig, rather. So no penis. A widespread bug has compromised a special type of Bitcoin transaction that is supposed to discourage miners from cheating, new research shows. In a report released in late April, pseudonymous engineer 0xB10C found more than 1 million of these, quote, time-locked transactions between September 2019 and March 2020 were not accurately enforced by the network. This increases the risk of a hypothetical form of attack in which miners could essentially steal Bitcoin from other miners. The bug affects 10% of time-locked transactions, or 2% of Bitcoin transactions overall. The findings highlight a key area of Bitcoin research that aims to stop miners from growing too powerful or cheating in various ways so that the world's largest cryptocurrency, with a market capitalization worth around $173 billion, works as designed. 0xB10C is one of a global network of developers and researchers battle testing the network to guard against even theoretical attacks, so that so far haven't been much of an issue. A time-locked transaction prevents the recipient of Bitcoin from accessing it right away. Instead, the person must wait until the network has added a certain number of blocks to the ledger. Since each new block takes about 10 minutes to record, a time lock can be programmed to expire at an approximate point in the future by setting a corresponding block height. Let's see here. One use case for this feature is a form of vesting. Startup Blockstream has paid employees in time-locked Bitcoin, for instance, which theoretically gives them an incentive to do what's best for the network's long-term value. But the faulty time locks 0xB10C detected, and does that spell something? Oxblock or 0xblock, I guess. Zero block or whatever. Oxblock detected had a more immediate purpose set for the current block, so they are not valid until one block later. They are designed to make, quote, a potentially disruptive mining strategy called fee sniping less profitable, Oxblock said. With fee sniping, a malicious miner tries to replace a block someone else just mined with their own, including the same transactions plus potentially other transactions that are still pending. The time lock prevents them from including the latter, limiting the spoils from the attack so that it is not worth the bother. A long-term risk. The likelihood of such an attack might increase as transaction fees, which users pay to prioritize their payments, become a more important source of income for miners. Right now, miners mostly rely on block rewards of newly minted Bitcoin to cover their costs, but this revenue stream decreases over time, as Bitcoin's network recent halving shows. Quote, currently not enforcing a time lock to absolute block height does not have consequences for the majority of transactions. In a few years, when the block reward consists mainly of transaction fees, it might make fee sniping more profitable, Oxblock told CoinDesk. Hence, the bug could be harmful to the wider network, but right now, it's more likely a, quote, low-priority problem to fix for most wallet services because it doesn't result in users losing money or affect time locks set further into the future, Oxblock said. Plus, the bug is a privacy leak for users. The oddly formed time lock is different from all of the other time locks on the network, so it's easy for blockchain voyeurs to see that the transaction is coming from a particular wallet. Many of the faulty transactions Oxblock detected were made by a single large entity, which he did not name, Coinbase. The engineer said he reached out to the entity producing the buggy software, who responded, quote, professionally. He said, coming up with the solution to the problem, it might take time for the solution to roll out, however. Quote, a fix for this has been released in early 2020. However, it will take a while before all instances of the currently deployed software are upgraded. Oxblock hopes his research will raise awareness of the risk of fee sniping attacks, so wallets that haven't set the time-locked transactions correctly can make the fix, making the Bitcoin network a little more robust. He was able to pinpoint and contact the largest entity producing these flubbed transactions, but there are others out there making the same mistake. Quote, it's hard to find the respective implementations creating these transactions, Oxblock said. Some of them might not be open source, making it even harder. Yeah, too fucking bad. You know? You set the conditions people can participate by, but they're not necessarily going to do so exactly according to your desires. And this is pretty indicative of that fact. You know, that there's always going to be mistakes made, but the bigger thing to do is to kind of look above it and say, you know, what is the impact going forward for the greater Bitcoin community? You know, is this the liability so significant that it's going to cause us issues later down the line that are going to harm a significant number of people? And see, personally, I think that there are a couple of things floating around out there that are of that class of problem and that are being widely ignored. And mostly it's because we can ignore them to some extent at this time. However, that time is ending. I'm starting to hear people bitch about transaction fees being in excess of $5 for their transactions, and that's not a good place to be putting Bitcoin. You know, I mean, when they're moving thousands of dollars now, okay, you know, they're not going to bitch too much, but in the not so distant future, when it's costing them thousands of dollars to move thousands of dollars, they're going to be bitching a lot more. As a matter of fact, they're probably going to abandon Bitcoin a lot earlier than that. I think the threshold now is basically three figures in U.S. dollars or any other fiat currency for that matter. But you get up over $100, there's something wrong with your fucking network, man. I don't care how many transactions I'm doing. I don't care how much the transactions are worth. It's too much. You know, and especially when if I were doing the same transaction in Doge, which is entirely possible, you know, I might have a little bit of difficulty accumulating enough Doge to do it initially. However, I could probably do it. And I could probably do it a hell of a lot cheaper, even if I had to wait till I could manage to accumulate enough Doge to do it with. Even then, I believe that I would be able to move the millions of dollars for a fraction of a penny. Maybe a couple pennies. But not no $5, not no $10, not no $20, $50, $100. No. Millions of dollars for a few pennies at most. And this is the differential that's going to make a difference with regard to altcoins and whether or not people stick with using Bitcoin. I mean, I gave that up. Using Bitcoin as money, I kind of gave that up about, probably 3 or 4 years ago. And, you know, I'm not the most intelligent or sophisticated user. I get told a lot that I'm pretty intelligent, but I've yet to be able to really put it to a positive income use. Well, I shouldn't say that. I trade okay, but nonetheless, it's telling to me though that we should be seeing issues with regard to these time lock transactions. As far as exactly who it is and what the faulty issue is, I couldn't tell you specifically, but we're probably going to find out a bit more in this Meow report. And let me see how long this thing is. It's not terribly long. I think we can get through all of it. Alright. And this is by Oxblock, German Bitcoin freelance developer. The stare pattern in time-locked Bitcoin transactions. The the off-by-one error that covered another off-by-one error up. And this is on Monday, April 27th, 2020. Some of the regularly used Bitcoin wallets, for example, the Bitcoin Core wallet and the Electrum Bitcoin wallet, set the lock time of newly constructed transactions to the current block height. This is an anti-fee sniping measure and is visible as a stare-like pattern when plotting the time-locked transactions by their mempool arrival time and lock time. The plot, however, reveals transactions time-locked to a future block height. These should usually not be relayed through the Bitcoin network. Bitcoin transactions can contain so-called time locks as a time-based validity condition. Different types of time locks are used in Bitcoin. The focus here lies on transactions time-locked with a lock by block height to an absolute block height by utilizing the nlock time field. This field holds a 32-bit unsigned integer and is present in every Bitcoin transaction. An nlock time value between 0 and... what is that? Is that 50 million or something? 1, 2, 3, 4, 5, 6. 500 million specifies a lock by block height. Okay. The Bitcoin consensus rules define that a transaction with a block by block height of n can only be included in a block with a height of n plus 1 or higher. Likewise, a block with the height of n can only include transactions with a lock time of n minus 1 or less. At least one input of the transaction must have an n sequence below 0 times FFFFFF for the time lock to be enforced. Otherwise, the lock is ignored. The Bitcoin Core software does not relay transactions with an enforced time lock higher than the current block height. Some Bitcoin wallets specify a lock by block height with the current height when creating a new transaction. This makes a potentially disruptive mining strategy called fee sniping less profitable. Fee sniping is currently not used by miners, but could cause chain reorgs in the future. Since the block subsidy declines to 0 over time, transaction fees will become the main monetary incentive for miners. If a recent block contains a transaction paying a relatively high fee, then it could be profitable for a large miner to attempt to reorg this block. By mining a replacement block, the sniping miner can pay out the transaction fees to himself as long as his block ends up in the strong chain. The fee sniping miner is not limited to pick the same transactions as the miner he is trying to snipe. He would want to maximize his profitability by picking the highest fee rate transactions from both the to-be-replaced block and the recently broadcast transactions currently residing in the mempool. The more hash rate a fee sniping miner controls, the higher the probability is that he will win the block race. Miners have the risk of losing such a block race, leaving them without a reward. A constant backlog of transactions is paying a similar or even same fee rate would be needed to incentivize miners to move the chain forward. When mining a second block yields roughly the same revenue as sniping the previous, then a rational miner would not start a block race. However, setting the current block height as the lock by block height forbids a fee sniping miner to use the transactions from the mempool to use transactions from the mempool his replacement block or in his replacement block. It creates an incentive to move the chain forward to be able to include the next batch of time lock transactions in a block. While this does not fully mitigate fee sniping, it reduces profitability. The more transactions enforce a time lock to the current block height, the less profitable fee sniping is. Let's see. Example, making fee sniping less profitable by setting the current block height as the lock by block height, block B2. And sorry, that's just a description of it, of the illustration it gives us here. When the block height increases, the time locked newly constructed transactions should increase as well. Transactions with the lock time set to the current block height should appear as a stair pattern when plotted by mempool arrival time and lock time. Observation. Transactions observed by Bitcoin Transaction Monitor project on December 17, 2019 are plotted. A stair pattern of transactions with a lock by block height is visible. It's a neat little chart there. The scatter plot shows a dot for each transaction with a lock time of between 608.507 and 608.519 that was broadcast on December 17, 2019 between 12:06 and 14:08 UTC. The radius represents the fee rate, the transactions paid, blocks found in the displayed time frame are drawn. Okay. Yeah, some transactions are locked to a height below the current block height. These are likely not broadcast immediately after their creation. This happens, for example, with high latency miners and some CoinJoin implementations. Additionally, the Bitcoin Core wallet randomly chooses a lock time of up to 100 blocks below the current height for 10% of the signed transactions to increase the privacy of the not immediately broadcast transactions. The plot, however, does not show transactions with two different lock times arriving at the same time. Transactions time-locked to the current block height and transactions time-locked to the next block height. Between block 608.511 and 608.512, for example, transactions with the lock time of 608.511, the current height, and 608.512, the next block height arrived. These should normally not be relayed through the network. Interpretation. The transactions time-locked to the next block height have inputs with an end sequence number of 0 times FFFF. The lock by block height is thus not enforced. All of these transactions have common properties and share a somewhat unique fingerprint. All are spending P2SH, nested P2SH, P2WSH or P2WSH inputs and are BIP69 compliant. Inputs and outputs ordered lexicographically. Most of them pay a fee rate of 12.3 satoshis per byte, per V byte, and all spending 2 of 3 multi-sig inputs. This leads to the assumption that these transactions are constructed with the same wallet or by the same entity. The fingerprint, especially spending 2 of 3 multi-sig, limits the number of wallets or entities which the transactions could originate from. Reaching out to a possible entity which prefers to remain unnamed proved to be successful. They confirmed the 2 off-by-1 errors. Firstly, the transactions should be time-locked to the current block height, and not the next block height. Second, at least one of the inputs should have n sequence number of 0 times FFFFFF minus 1 or less for the time lock to be enforced. A fix for this has been released in early 2020. However, it will take time before all instances of the currently deployed software are upgraded. Between September 2019 and March 2020, about 10.9 million, 19% out of the 57.49 million total transactions set a lock time. Out of these, 1.16 million transactions had an unenforced lock time. That represents 2% of the total and about 10% of all transactions with a lock time. More than 98% of the transactions with an unenforced time lock share the same fingerprint as the transactions observed on the 17th of December. The remaining 21,577 transactions are likely broadcast by other entities. Out of these, 19,956, 92.5%, have an unenforced lock by block height, and 1627.5% an unenforced lock by block time. Some transactions with unenforced lock times might have valid use cases, while others unknowingly set an unenforced lock time. Conclusion: some Bitcoin wallets reduce the profitability by time-locking transactions to the next block. This appears as a stair pattern when plotting the arrival time and the lock time of transactions. The plot reveals transactions with lock times higher than the current block height. These should usually not be relayed through the Bitcoin network. This leads to the discovery that a large entity transacting on the Bitcoin network does not properly set the end sequence field of their transaction inputs. This allowed for the off-by-1 error in the transactions lock times to remain unnoticed. Yeah. So, I guess it's good that they caught it. It's probably an error that should not exist. I mean, why not just settle the transaction? Do the fucking transaction, settle the transaction, get it done with. Personally, I think what these are an attempt to get around the fact that you need to do an initiating transaction and a terminating transaction for Lightning Network, for their payment channels. And so they're trying to do it to where they only have to pay one transaction fee, and it's like a month from now, and the payment channel is set to close. All of the payments are to go to the appropriate parties, but they're only going to pay one transaction fee, or at least that's the plan. Clearly, it's causing some issues elsewhere in the network, though. Otherwise, it would have continued to go unnoticed. let's go ahead and throw back down with some music. I got a neat song playing. I really like this one. So let's go ahead and go with this. Metallica, Disposable Heroes, here on Coin Metal. And that was Rammstein with Tear. And so, as far as where we're going to go next, man, Twitter. All over the place today. But yeah, so we covered that. And we covered the bug. Here we go. This is, I think this is kind of related to the last thing that we were just talking about, but I'm not entirely sure. So, of course, we're going to have to get into it. And so this is on Coindesk.com. Crypto researcher Hasu flags attack that could bring, quote, purge-style mayhem to Bitcoin. And this is authored February 6, 2020. Weird. I'm amazed that I didn't see this earlier. But this is February 6th, so a couple months ago. Anyway, we'll go for it anyway. This is at 15:30 UTC on February 6th. And this was authored by Alyssa Hertig. So no penis. Pseudonymous researcher Hasu has discovered a new twist on a well-known potential attack on the Bitcoin network. The researcher posted a description of the attack, which he named Purge, after the B-movie franchise to the Bitcoin developer email list last week. It's a variation on the so-called sabotage attack, in which malicious miners try to wreak havoc on Bitcoin for the sake of wreaking havoc rather than for profit. Quote, purge attacks probably don't constitute a bigger risk than other known forms of sabotage attacks, but seem like an interesting spin, he wrote. In the dystopia of purge films, the U.S. government legalizes all crime for one night every year to unleash a sort of national catharsis. Hasu said he chose the name because the attacker doesn't primarily steal money himself. He makes theft legal in the network for a short period of time. In short, the attack opens the possibility that in very particular circumstances, some users could spend their bitcoins more than once, something the unique technology behind Bitcoin is supposed to prevent. To be clear, the scenario is hypothetical, like many other Bitcoin researchers have identified in their networks, to steel the network against real-world sabotage attempts. Anticipating the danger is the first step towards preventing, or at least mitigating it. Undermining trust. In order to execute a purge attack, a rogue miner would replace an already accepted block with an empty one, pushing transactions that were previously seen as final back into the, quote, mempool, which is like a waitlist for transactions. Then, anyone who sent a transaction during that time can spend the same coin twice. The new type of sabotage could be used to, quote, undermine trust in Bitcoin's assurances, such as the assurance that transactions are, after a time, quote, final, meaning irreversible. Possible attackers could include nation-states hostile to Bitcoin, as well as terrorist organizations, Hasu added. Further, Purge is different from other sabotage attacks because the users who were suddenly allowed to double spend could get incentive to go along with the attack. Quote, because Purge gives normal users a way to benefit from the attack, the attacker hopes that it will be harder to coordinate a response quickly because whoever benefited from the attack has an incentive to defend the attack chain, Hasu told CoinDesk. But while the purge is a new idea, it's not necessarily worse than other known attacks. Hasu points to a couple of lines of defense. One, the risk of the attacker of losing block rewards, which are expensive to win, could decline in value if the attack shakes confidence in Bitcoin. And two, the, quote, strength of Bitcoin's pre-coordination. The full report on Bitcoin's future exchange Deribit blog dives into much more detail, and we may or may not get into that. Yeah, that's very interesting. I mean, there's never been anyone out there that will tell you that Bitcoin is final in its development and that it isn't subject to potential attacks. I mean, we're talking about money. So, I mean, people have tried to get money before. They're going to try and get money tomorrow. You know, I mean, it's very plain, very simple. It's a matter of incentives. If there's a greater incentive to cheat or attempt to defraud individuals than there is to maintain good faith, then people are going to fucking cheat. That is all there is to it. Anyway, so let's see what else we got here. We got that, the hypothetical attack. We got that taken care of. I mean, just imagine for a moment if one of the transactions that was being double spent was one of your transactions. Or if that's even possible, I wonder. I don't know. But I got a couple other things I wanted to get into here. Let's see here. No. Show vendors. Yeah. Okay, I agree. Whatever. Here we go. This is the kind of thing that I'm worried about. And it's because it hasn't really stopped. This has been a threat that's existed for quite a while. And it resurfaces every so once in a while. Anyway, this one's on thetimes.co.uk. RBS manipulated evidence to defend its restructuring group. And let's see here. This is by James Hurley, Enterprise Editor, and it was authored June 1st, 2020 at 12:01 a.m. BST, The Times. Royal Bank of Scotland has been accused of using manipulated evidence in court to defend itself against accusations related to its notorious global restructuring group. A business owner who lost a GRG-related claim against the bank and its NatWest subsidiary in 2018 has been given permission by the High Court to replead his case concerning allegations that the original judgment was, quote, procured by fraud after document tampering. RBS said the allegations are without any merit. Jonathan Broomhead, who ran JMB Holdings, a construction business in Derbyshire, had sued RBS for $13.8 million over claims that NatWest breached lending commitments. Let me see here. I want to continue reading, but it looks like the Times is not letting me. That's okay. I'm sure that this was a report somewhere else, and it was because of a report somewhere else. Let's see here. Report. Let's see here. Oh, there's one. Might be able to get into it there. The Guardian, maybe. Here we go. That one might do it. And that one's too old. Alright, so let's see here. Here we go. And this is on BuzzFeed, of all places. BuzzFeed.com. The Dash for Cash. Leaked files reveal RBS systematically crushed British businesses for profit. Let's see who this is by. And it's got a specific individual on there, it looks like. Let's see. This was authored too old for us to go into. No. we're not going to. Let's see here. I'm trying to find one that's current. Let's see. No, it's Jim Broomhead. That's gonna be that Times article. Let's see here. Trying to find the actual report. Let's see here. Yeah, that's not it. Let's try this again. We're gonna go with anytime past week tops. There we go. This is on Reuters, and this is off of Press Digest, and it was authored May 31st, 2020, 6 p.m., so a day ago. And so, yeah, let's see if it gives us a link. No, it's just a bunch of fucking articles. God damn it. Summon a fish. I was hoping that was going to be a regular article, but apparently not. Let's see here. Let me see if I can find it. Oh, that's a PDF. Is that it? Collapse of European Bank. That was 3 days ago. Oh, wow. I don't know. We might get into that one. That looks appealing. Let's see here. So that's... I think this one links back to the Times, so we can't do that one. Because I don't subscribe to the Times, and they've got a fucking paywall up, so yeah, we can't play with them. Let's see here. No. We might just go to that one. Alright. Well, hell. Let me see if I edit it, if it'll change things. Alright. Paste. Let's get rid of the group. See, I'm trying to find the article, like, where it doesn't relate back to the fucking Times, because apparently the Times has got, like, the only hook on this. Shit. Well, let's try the... here we go. This is on theguardian.com, and it's connected a little bit. Oh, shit, never mind. It's more than 5 years old. So apparently this thing has been like a black hole for a little while. That, you know, it got quashed out of the courts illegitimately, and it's like waiting to resurface somewhere else, and apparently it's starting to. But let's see here. I got this thing here. It's some sort of report. Let's find out how long the thing is. I don't know if I want to go into this one, because I mean it's a big report, and it's quite detailed, and it's quite off of what we were actually talking about. So yeah, I don't think we're gonna do that. Let's see here. I do have another one though that I did want to get into, and if I can find out where the original article was. Goldman Sachs report Bitcoin. Alright. What the fuck? Goldman. Report. Bitcoin. Here we go. And this one was May 28th, 2020 at 6:44 EDT. It was by Ben Jessel. Goldman Sachs slams Bitcoin and gold on investor call. Crypto community reacts. Goldman Sachs hosted an Goldman Sachs hosted an investment advisory call for its clients yesterday, which reignited a long-running dispute between cryptocurrency and the banking community. The investor call, dryly entitled U.S. Economic Outlook and Implications of Current Policies for Inflation, Gold, and Bitcoin, was announced to Goldman Sachs clients last week. While the invitation gave little away around the nature of the insights of the bank was going to share, some in the cryptocurrency community read between the lines, concluding that the financial services giant was about to signal to the market that the recent unprecedented economic events may have finally persuaded the bank to endorse Bitcoin, given its association with being a hedge against inflation. Nothing, it transpired, could have been further from the truth, as the selected few who attended the invitation-only call were quickly to learn. Rather than endorsing Bitcoin, the analysts instead presented a scathing analysis of the cryptocurrency. Let's see here. Bitcoin is not an asset class. Almost immediately, the slides from the call were leaked to social media, causing the cryptocurrency community to erupt in displeasure. In a slide entitled, "Cryptocurrencies, including Bitcoin, are not an asset class," the bank alliterated a number of reasons to support its view that Bitcoin lacked legitimacy, stating that it provides no cash flow or earnings through the exposure to global growth, nor does it provide diversification, nor dampen volatility, and has shown no evidence of being an effective hedge against inflation. That's funny. Invoking the greater fool theory, the analysts concluded, quote, "We believe that a security whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it is not a suitable investment for our clients." Drugs, guns, tulips, and gold. The bank continued to twist the knife by then highlighting historical cases where Bitcoin has been used for illicit purposes. Goldman analysts were also dismissive of the argument commonly made by Bitcoin bulls that while Bitcoin itself does not offer dividends and coupon payments, it has value based on scarcity, in much the same way that gold does. In other words, if gold and silver can have value, then so can Bitcoin. Tulips were scarce too, and still people lost a lot of money, argued the analysts, adding that Bitcoin's metric rise, it's meteoric, dipshit, and subsequent fall were much worse, comparatively, than in Gouda tulip bubble of 1636 through 1637. Actually, the tulip bubble had a function behind it, and I think it's not widely underscored what it was, is that tulips were used to maintain your walls because of the root systems of them. Anyway, continuing on. The investment analyst also poured scorn over the notion that Bitcoin is actually scarce in the first place, explaining that while there is a fixed supply of 21 million coins, there have been various forks of Bitcoin which, in essence, demonstrates that an abundance of the cryptocurrency can be increased with the mere click of a button. Or a few. That's bullshit too. It wasn't purely Bitcoin that received a thumbs down from the banking giant. The bank also gave gold a short shrift. God damn. Dude, you guys don't know how to spell. Challenging conventional wisdom that it is a natural hedge against inflation. Yeah, but they've got safes full of the shit, so whatever. Or if they don't, they really shouldn't be in business. Goldman concluded that unlike equities, gold has not consistently outperformed inflation, only doing so in rare high inflation situations. No, wrong. Gold is the thing that shows what the real rate of inflation is, but the problem is that during the time when the inflation is happening most, the banks and whatnot do what they can to distort the relative value of gold by circulating certificates and selling certificates that are supposedly representing volumes of it in its stead when they don't actually have the gold. Anyway, continuing on. But point I was getting to there is that there's a point when too many people ask for their fucking gold. And Goldman Sachs says, oh, we don't have any more gold. Sorry. And the rest of the world is like, dude, you've got like $34 trillion worth of gold certificates still outstanding and you're not able to cash any out? Fuck you. And then if anybody burns anything, it's Goldman Sachs outlets. Continuing on. Goldman concluded that unlike equities, gold has not consistently outperformed inflation, only doing so in high inflation situations. See, that's the point when the game becomes so obviously fucked that nobody believes in the thing that you're trying to spend in the stead of gold. That's why it catches it in quote-unquote high inflation situations. It's because that's the thing that after a while the gold miners say, no, I'm not going to take these dollars in exchange for my fucking gold. You're going to give me a credit tab for 300 tomatoes or whatever per month, until we're paid off, and this is going to be a 4-month contract or some shit like that. Anyway, continuing on. Goldman, it appears, is no gold bug, which means they're completely insolvent and all they have is IOUs from other banks. Reaction from the Bitcoin community. The reaction from the Bitcoin community was swift, with many taking to Twitter to throw shade on the analysts' comments. Cameron Winklevoss, co-founder of cryptocurrency brokerage Gemini, gave Goldman a lesson on a 5-year-old ruling from the Commodities and Futures Commodities and Future Commission, and they forgot trade in there. While Melton Demers, Chief Strategy Officer at CoinShares, which provides professional-grade tools and services for investors seeking exposure to digital asset classes, also weighed in. Demers suggested that Goldman may not be in the best position to cast aspersions about Bitcoin's role for money laundering. Snarky tweets aside, to fully explore the perspective of the cryptocurrency community, I turned to a brain trust of the aforementioned Mrs. Demers, Bill Berryhide, CEO of leading cryptocurrency wallet provider Abra, and Rory Manchi, Director of Business Development at Brave New Coin, a respected data and research company focused on the blockchain and cryptographic assets industry. Demers reminds me that Goldman isn't infallible and has made some spectacularly wrong calls in the past concerning massive technology-based trends. Quote, Goldman was bearish on the internet in 1994, points out Demers. Not every call is going to be the right one, and clearly there are many notable investors and institutions who are allocating to Bitcoin. In pointing to notable buyers of cryptocurrency, Demers may have been referring to Paul Tudor Jones, a leading hedge fund manager who revealed earlier this month that he has a firm crypto investment strategy in place, allocating 1 to 2% of his assets to Bitcoin. In the same vein, a recent analysis of Grayscale Trust, a private issuance financial product that enables retail investors to gain exposure to Bitcoin through their brokerage account, has indicated that retail buying of Bitcoin has been on a tear over the last month, significantly outstripping supply, suggesting that the investor presentation and crypto community's reaction to it may be somewhat of a storm in a teacup. Demers goes on to highlight how the attention of the growing crypto community can magnify a fairly run-of-the-mill client investment advisory event. Quote, "The world is quickly figuring out that the millions of active members of the crypto community and the millions of eyeballs tracking crypto news are a good audience to engage for attention," says Demers. And arguably, Goldman received a lot of attention for a relatively mundane and otherwise uninteresting report with very vanilla takes. Another point Demers makes, which has been echoed by many in the crypto community, is that the bank's advice is ultimately going to be a function of who their current clients are. Quote, "As the wealth of crypto holders and crypto companies grows, just like JP Morgan and so many others, Goldman will have to start courting these clients who have vastly different preferences and needs than their legacy clients," says Demers, adding, quote, "If it's profitable, Goldman will inevitably get into the business." Striking a less philosophical and conciliatory tone, Barry Hyde, CEO of Abra, was incited enough by Goldman's analysis to dedicate a portion of the content of his regular newsletter to his Abra wallet clients, where he provided a point-by-point takedown of the bank's analysis. Goldman is part of the system. Actually, they're part of our system too, so don't be all getting up on yourself. They run a stable coin through Circle. You might have used it. It's called USDC. Continuing on. For Barry Hyde, Goldman's position on the traditional global finance system means that philosophically, the investment bank will naturally be opposed to Bitcoin, which, after all, offers an alternative to Wall Street and central bank-issued government-backed money. Quote, "Every government-backed currency has failed. Goldman received millions from the troubled asset relief package from the U.S. government. They are part of the system," said Barry Hyde during our discussion, turning his sights to the argument that Goldman makes that the ability to fork Bitcoin removes scarcity. It simply doesn't wash with Barry Hyde. Quote, "If there were any validity to Goldman's point about Bitcoin not being scarce, then the creation of new coins would constantly erode Bitcoin's market dominance within the crypto space. This is not the case." To further expand on Barry Hyde's point, cryptocurrency is not purely about code, it's about adoption and utility. It's certainly one thing to copy and paste open source Bitcoin code. It's quite another to build a community that adopts the coin through mining, investing, and transferring it. Motherfuckers are fucking listening to my show. That's exactly the case I've been making for the last, 4 fucking years maybe? Continuing on. Getting more analytical, Barry Hyde points to quantitative analysis of Bitcoin. Quote, "Hard money is best understood via stock-to-flow ratio, which is an asset's existing supply versus the relative rate at which the supply will be increased at any time in the future. Bitcoin has potential to have the hardest stock-to-flow ratio of any asset ever, but Goldman would have us believe it's not a new asset class." Actually, the stock-to-flow stuff is bullshit when it comes to Bitcoin, because there is always the matter of market preference. And the volatility of Bitcoin is due to the fact that it can transition in such a quick period of time. You can send Bitcoin to anybody in 10 minutes or less if you're using the appropriate fees for the amount and whatever. And that is in such stark contrast to our legacy markets that they cannot conceive of global settlement in 10 minutes. They do global settlement in 3 to 5 business days. That's an entirely different time frame. Continuing on. Manchi continues that the thought of Bitcoin as a new type of asset class requiring a whole new paradigm shift in thinking, stating, quote, cryptocurrencies represent a fourth superclass of assets. They can function simultaneously as capital, consumable, transformable, a store of value assets, thanks to their permissionless, distributed, and cryptographically secure nature. Yeah, that's true. He also takes issue with, albeit does not flatly contradict, Goldman's assertion that Bitcoin is not an inflation hedge. Quote, in terms of appreciation, Bitcoin has clearly outstripped inflation in recent years, but that's not been difficult in a mainly low inflation rate environment. That said, look at the interest that Bitcoin has achieved in countries with hyperinflation. He also points out that while Bitcoin itself does not generate a revenue stream, just like money, it can be lent to institutions that are prepared to pay interest. Celsius, for example, is offering Bitcoin collateralized lending rates of 4 to 6% today. Furthermore, points out Manchi, quote, there are other coins that support staking, which can generate income for token holders. Same bank, many takes. Bitcoin, and for that matter gold bugs, shouldn't be too disheartened by Goldman's investor presentation, as it doesn't mean the bank itself is necessarily against the asset class in all scenarios. Banks are large organizations with many different lines of business and often hold multiple seemingly contradictory perspectives simultaneously. After all, Goldman has a significant investment in a thriving over-the-counter Bitcoin brokerage business that services institutional clients. And to further illustrate that point, and a twist of irony, on the same day as the Goldman briefing, a research note purportedly penned by research analyst Nikolaos Pantagerzoglu from JP Morgan recently circulated on Twitter. The report claimed that the intrinsic value of Bitcoin, if analyzed from a commodity perspective, was 25% below what it should be. That's the same bank whose CEO in 2017 labeled Bitcoin as a fraud. It's never a dull day in crypto. God damn right. I think that one of the things that Goldman has the biggest problem with is the fact that they are not a primary trendsetter when it comes to Bitcoin or crypto for that matter. They're not one of these entities that if they say it, everybody in the world fucking listens to it and it makes some sort of appreciable impact on the relative price of a coin or a project. That's not the case with Bitcoin because they don't really supply much to Bitcoin. They make services on top of it. They utilize it as an asset in multiple scenarios within their business, and they make money off of it. But to my knowledge, by and large, they've stayed out of mining, and they've tended just to the process of processing transactions on behalf of their clients. And that's pretty much it. And while that might have some value for their clients within, I think over the longer term, they're going to find out that the proliferation of new projects and also the dynamism of projects that they had no interest in to begin with, that have been around for years and that suddenly go through some major appreciation in price, that because they aren't able to get in on everything, that their position even in Bitcoin and existing cryptocurrencies will compromise them. In that they will lose money versus everybody else. It's one of those things that no matter where you put your foot, you've got to anticipate the future flow. If you're not anticipating the future flow, you're going to get wrecked. And you cannot be in love with a particular flow because it's going to go from one to the other. And again, you're going to end up missing out on it. Anyway, let's go ahead and throw back down with some music. And let's see where we're at here. Yeah, I think it's about time for that. Let's see. We haven't been playing any Rivers of Nile. And I think that's warranted. The Silent Life. Here on Coin Metal. And that was Probot with My Tortured Soul. And it is with that I'd like to close out this episode. Thank you very much for listening. I certainly do appreciate the support. We will be back again on Wednesday at 8 p.m. Pacific Standard Time. And so until then, I want you all to trade safe. Do your homework. And watch out for your own bunghole, because nobody else is going to do it for you. And as far as our last dance is concerned, of course I have not picked anything else, or nothing out. And I'm looking for something right now. And, let's see. We've already played a little bit of Prong. We like Prong. We've already played them. We played some Sixth. We haven't played any Skindred in a while. And I think this song is kind of appropriate because I don't think anybody is going to get out alive. And so here it is, Skindred, Nobody. Last Dance here on Coin Metal. Thank you again for listening, and you all have an excellent evening. Good night.